Well, hi everyone, Shaun Humphries here. Welcome to All Things Retirement. Well, in this installment, we're going to talk about the fixed income market or the bond market or individual bonds. Why is that topic relevant? Well, we had the banking crisis in the United States sort of rolling in front of our very eyes with the collapse of Silicon Valley Bank and other regional banks. And one of the things you've been hearing about is these banks, particularly Silicon Valley Bank, put a bunch of their depositors' money in mortgage-backed securities and government bonds. You wouldn't think that would be a risky strategy, but as it turned out, it was risky. And then it's also relevant because last year the bond market didn't do our portfolios any favors. So why didn't the bond market do well? What influences what we think of as a relatively risk-free or riskless assets, government bonds? But they do have risk attached to them. We'll talk about that. We'll also talk about why you'd have bonds in your portfolio to begin with if there's some risk attached to them and how to properly invest in bonds and how to look at bonds in the context of your portfolio. So I think you'll find this video helpful. We've talked about bonds in the past, but I think it's good to revisit some of these topics, particularly when the topic is in the news. Now, if you're new to our channel, make sure you hit the subscribe button. We're posting content all the time on various aspects of retirement income planning, as well as overall wealth planning. So if you don't want to miss future content, click subscribe. As well, we have some free resources at our website. There's links in the description notes for this video. Just go there, hit the link so you can get those free resources. Okay, let's talk about the bond market and how we should look at bonds in the context of most recent events in the United States and for our portfolios. So the first question we're going to tackle is, are bonds risky? Well, that depends. So let me just show you something on the screen here. So if I bought a federal government bond in Canada and the government has unlimited powers of taxation and they print our money, so that's a pretty good guarantee. And so if I put $10,000 in the bond and that bond paid 4% interest through the course of the year, I'm going to get $400 of interest payments. And let's say the bond maturity is in the year 2028, and in the year 2028, when that bond matures, I'll get back my $10,000. That's about as guaranteed as it can get, right? And in many ways, that's like buying a term deposit or a guaranteed investment certificate through your trust company or bank. Now, the only difference there, though, is that with guaranteed investment certificates and term deposits, as an example, they're normally not traded on a secondary market. So you can't sort of buy and sell or trade those GICs or term deposits before their maturity. But with government bonds, you can do that. You can do that with corporate debentures, so corporate debt, government bonds, provincial bonds. They're all tradable securities. And that's where the discussion around risk comes to play. So let's take a look at that aspect. So on one level, if you just hold your bond to maturity, you're going to get back your $10,000. You're going to get $400 per year. That's pretty risk-free, right? That's a low-risk investment option. But let's now take a look at bonds as it relates to the fact that they're tradable in the secondary bond market and what influences their valuation levels. Now, the first thing that I want to talk about is the secondary market for bonds. And so if in fact we can buy and sell bonds after we purchase the bond, what is going to influence the value of that bond at any given moment? And we'll talk about those influences in a second. But the first thing that we'll take a look at is just a little bit of a schematic or a drawing I put together here for you. Very rudimentary, but it's going to illustrate the point. And then we're going to take a look at those factors that influence bond prices. So let's say that we have our $10,000 bond again, and we're earning 4% on that bond. It's paying $400 per year. Now let's say that after we purchase that bond, interest rates actually go down. And so we've got a 4% bond paying $400, and then in the general economic environment, interest rates go down to 3%. So anyone that has money to invest, let's say $10,000, is not getting $400, they're getting $300. Now, what do you think will happen to my bond as it relates to its value? Well, obviously, in an environment where interest rates are 3% and I'm getting 4%, my bond is more valuable. It's going to trade at a premium. If I want to sell that bond, the market will pay me a premium. In my example, roughly speaking, I could sell that bond before maturity for $460 more than what I paid for it, right? Now, if I sell it, I'm giving up my 4% interest rate, and if I'm reinvesting it back into bonds, I'm getting 3%, right? So I might sell that bond because I was going to need the capital anyway. Maybe I'm going to put it in real estate. Maybe I have an expense coming up. Maybe I'm going to put the money in stocks because I think they're a better option for my portfolio. But nonetheless, if I do sell it, I'm going to get a bit of a premium, a capital gain on that bond. Now, the reverse, of course, is true. If I have a bond paying 4%, interest rates now are 5%, new money can get $500, not $400. What's going to happen to my $10,000 bond in terms of price? It's going to trade at, let's say, $9,560. It's at a loss. If I had to sell the bond, I would have a loss on that portfolio. And that is the major sort of teeter-totter we work with bonds. Now, if you just hold this bond to maturity, no issues, right? You're going to get your $400 a year, 4% interest rates. But if you have to sell, it may trade at a loss, may trade at a gain, depending on your interest rate. Now, interest rates won't be the only things to take a look at. There are some other factors that drive the fluctuation rate of a bond. So let's take a look at that. Now, when it comes to the fluctuation on bonds, there are many different factors, but we'll look at the main ones here. So the first one is, what's the current interest rate on your bond? So the current rate, or the coupon rate on the bond, it's often referred to as coupon, that will drive the fluctuation. So obviously, if you've got an interest rate that is 5% and rates fall to 2%, that's a great place to be. If you've got a rate of 3%, rates go back up to 5%, that's going to be negative. So interest rates on your current bond have an impact. So does duration, or the term to maturity of your bond. So if you have a bond that matures in 2 years, as opposed to a bond that matures, let's say, in 10 years, the degree of fluctuation on that bond will be less on the 2-year maturity than the 10-year maturity. So the longer you go out in terms of maturities or duration, the higher the fluctuation rate on the bond. The next area is credit quality. So a high credit quality bond, like let's say a federal government bond, compared to corporate debenture that might be a BB bond, the degree of fluctuation will be more extreme because the coupon rate, or the interest rate, is going to be different. It would be higher likely in a corporate debenture. As well, the credit quality will influence the degree of fluctuation as well. And then there could be the general economic circumstances. So where's the economy headed? What's the general sort of environment in which you're operating? And obviously does have an impact on the bond market and how bonds get valued. So this is really, really critical when we take a look at the bond market. Now, there are various ways of hedging risk, reducing risk on bonds in an environment where we want to make sure that our portfolio doesn't lose value. And so what are some of the hedging strategies that we can take a look at? Now, before we get into the hedging strategies, I'll talk about Silicon Valley Bank. Now, one of the problems with that whole banking fiasco is that for whatever reason, Silicon Valley Bank was asleep at the switch as it relates to reducing risk in their portfolio. So what happened is Silicon Valley Bank was a victim of its own success in many regards. So they experienced a massive increase in deposits over the last few years. And as the money was flowing into the bank, they were reinvesting the money in what they thought were conservative assets. And normally they are mortgage-backed securities and government treasury bonds. The problem was they were going longer term with those bonds to try to get a good coupon rate. And for whatever reason, they were not either worrying about the risk of interest rates going up or were asleep at the switch and didn't put any hedging strategies in play. So remember, we talked about how bonds fluctuate in the secondary market. In their situation, when people began taking money out of the bank, and of course the whole tech sector began to go through a bit of a downturn. We've heard about the layoffs in the tech sector. The share prices have gone down significantly. The economy's been slowing down, and they've really felt the economic slowdown. So venture capital companies and tech startup companies and people in general are going to the bank to withdraw their money. And then there were some reports that the bank maybe was having problems having enough reserves for the withdrawals, and that began to create a bit of a run on the bank. Now, the bank, I think, had sufficient assets. The problem is that they began to sell those mortgage-backed securities and long-term government bonds to try to bring up enough liquidity to honor the withdrawals that people were making. And that's where they got really caught. So remember, they were buying these bonds, trying to lock in great coupon rates and, put it in a conservative asset, but those valuations could drop. And so what happened is interest rates began going up quite dramatically through 2022. So the Federal Reserve Board was trying to fight inflationary pressure. Interest rates were going up. As a consequence, bond prices and mortgage-backed security values were going down. At the same time that was happening, people were wanting to withdraw their money and was forcing the bank to liquidate those bonds at losses. Now, had they not had major withdrawals from the bank, had interest rates not changed very much, they would have been fine. But they obviously did not hedge out their risks for whatever reason. And there are ways you can reduce risks in a bond portfolio, particularly for a bank that has money on deposit. You'd think that they would worry about those short-term risks. So let's talk about some of the strategies that can be used. So there are various ways that bond managers or bond portfolios can be managed in such a way to reduce the risks that come along with rising interest rates. So if you were a bond portfolio manager and you thought that interest rates might potentially go up, you could first of all shorten the duration of the bonds. So you could reduce your bond portfolio from long-term bonds to mid-term to short-term bonds. The shorter the duration or term of the bond, the less total fluctuation you would get if we saw interest rates going up. Another part of that strategy is to improve credit quality of the bonds. So you might go from corporate debentures or corporate bonds to more secure bonds or higher credit quality bonds like government bonds, whether it's federal government or municipals or provincial government bonds. So that could reduce the fluctuation as well. As well, you can buy bonds that are actually indexed so that if interest rates go up, the coupon rates automatically go up as well. And so those kinds of bonds are more resilient in a rising interest rate period because their rates will go up as well. So they won't go through the same downside volatility that I talked about earlier in this video. And then you can buy hedged bond portfolios or hedging instruments. And so they're often referred to as interest rate swaps. So you have investors out there, some who think interest rates may need to be locked in their portfolios. They're concerned about being in variable rate interest, and other people who are in variable interest rates and they want to swap it for a fixed income or a fixed term rate. And so interest rate swap contracts are out there. And so portfolio managers, if they have a perspective on rates, let's say they've got a great bond portfolio, they've got great yields, they really don't want to change the portfolio, but in the short term they think interest rates might go up. So they can buy these interest rate swap contracts that might do well in an environment where interest rates may go up. They can lock in an interest rate at a certain level, and if rates go up on them, then these swap contracts, interest rate swaps, would actually appreciate in value and counteract the depressed value in their existing bond portfolio. Now, those are just some of the strategies. Those aren't all of them, but there are definitely strategies that the fixed income managers can utilize to try to reduce some of that risk. And clearly, some of these banks, and Silicon Valley Bank seems to be a really great example of that, did not pay attention to these interest rate risks. Now, in saying all that, you have to go back a little bit further. I mean, a lot of this has been triggered because I think, poor policy. You saw a lot of policies being put in place over the last 3 years that were very inflationary. And the inflationary pressures were not dealt with quickly enough. And the late to the game initiatives by central banks to fight inflation forced them to ramp up interest rates very dramatically and create this volatility in the bond market, and led to a situation where asset managers were not able to respond maybe as quickly as they would have liked. Okay, so that's a little bit about bonds, how they fluctuate, some of the hedging strategies or risk reduction strategies you can initiate. And so it begs the question, if bonds are going to fluctuate in value, why would we have them in the portfolio to begin with? Let's talk about that. So when we talk about the role that bonds play in a portfolio, it really is a broader discussion around asset mix. So for many portfolios, it might be a mix of stocks, a mix of bonds, and you could have real estate and cash in portfolios. But for now, let's just look at two asset classes, stocks and bonds. So the chart that you have on the screen here, we refer to this cross correlation of assets. And really what we're getting at is if you look at investment A, we'll say that's stocks. It fluctuates over time. And then you have investment B, we'll say it's bonds. And you can see that the fluctuation is inverse to the stock fluctuation. And in fact, if you look historically, bonds have traditionally fluctuated inversely to stocks. And that's one of the main reasons you'd have them in a portfolio. For investors that are trying to moderate short-term fluctuation on the portfolio, they'll feather in other assets. It could be bonds, could be cash, could be real estate, to smooth out the pattern of return. So they have a goal return, but they also have a risk management goal as well. And so bonds play a very critical role in that calculation. Last year was very frustrating, so 2022 was very frustrating for investors, where when we saw the bear market hit, usually we see bonds rally. They didn't rally that year. Now, we fully expect that could potentially happen in 2023. We'll probably see interest rates peak, and as interest rates fall, likely in 2023 and early 24, if that happens, we'll see price appreciation on bonds plus some decent interest rates. So that's the first concept, is we put bonds in the portfolio to smooth out the fluctuation in portfolios, and in general that works out pretty well. Now let's take a look at various portfolio mixes to kind of demonstrate this in a very practical way. So what this chart shows you is the predictable range of returns on various portfolio mixes, and the mixes range from 100% bonds over here to 100% stocks over here. We've got the average return, we've got the best return, and the worst return. The time period was from September 2008 to December 31st, 2020. And you can see that on the growth portfolio, which was 100% stocks, the compounded return was 9%. The worst one-year rolling average was minus 18.9, and the best was 46%. If we look at the bond portfolio, the worst one year was minus 4.3, and the best was 11.3 with an average of 4. And then if we look at a balanced portfolio, let's say 40% bonds, 60% stocks, the average was 7.4% returns, 1 year downside of minus 13.1%, 1 year upside of 36.2. So when you look at these bar graphs, really what it's designed to illustrate, if you're a pension fund manager, managing an endowment, even your own portfolio, and if you have a goal return, you'll feather in bonds as an example to try to moderate the degree of fluctuation. So if you were an investor and you did a financial plan or retirement plan, and you found out that you needed to get a 6% return, if you got a 6% return, you could achieve your funding goals for retirement, then you might add bonds in your portfolio so that the range of fluctuation of the portfolio was much less than a portfolio that had a higher weighting to stocks. So the idea is, don't take on more financial risk than is necessary to achieve your goals. Okay, well that's really it for the presentation on fixed income investments or bonds. Again, the Silicon Valley Bank fiasco really puts under the microscope how bonds work. They play a very important role for portfolios, but they don't work so well when you've got short-term deposits, short-term need for money, and then an environment where interest rates turn quite almost violently, very dramatically, and these portfolio managers and banks didn't hedge the short-term risk very well. So hopefully you found the video helpful. Again, if you're new to our channel, make sure you hit subscribe so you don't miss any future content on various aspects of retirement and overall wealth planning. And again, if you go to our show notes, you can get links back to our webpage, our homepage, which has various educational resources that are complimentary. And you can also find out how you can get a complimentary financial planning forecast and second opinion. Anyway, wishing you all the best in your overall retirement planning and wealth planning goals. You take care. Bye-bye.